In this video, I'll show you how to trade on Binance Margin, all of the specifics you'll need to know, and some real trade examples as well. I'll leave timestamps down in the description. If you want to trade on the exchanges I use, I'll leave some deposit and trading bonuses on those down in the description as well. Before trading on Margin, I'll show you how the exchange actually lends us money. They never want a bad debt, and they're not just going to give us money to trade with. What we need to do is put collateral on our trading account first to pay for any potential losses in our trades. So let's say that I've got $500 in my Binance account. And what I can do with Margin is go ahead and borrow $500 more. Now, the reason the exchange can lend us this is because we have this cash in our account as value to pay for any potential losses in our trades. So let's say we go ahead and open a $1,000 trade in the market. Now, if that $1,000 trade falls by 30%, then we make a $300 loss on our trade. And we've got $500 of cash in our account to pay for that loss, so the exchange doesn't really mind about this too much. However, if that 30% loss turns into a 50% loss, then our trading loss is $500, and that is the same as the amount of cash we have on our account. What the exchange is going to do there is going to say, look, you don't have any more money to pay for any more losses, so we're going to take your $500, we're going to sell out of your trade, and we're going to pay the extra $500 in the losses and get out of your trade. And also you have no money left in your account. So in order to borrow money, you need some collateral on the system in order to pay for any potential losses in your trades. And so this is where leverage comes in, because the less money you have to pay for potential losses, that means you have higher leverage, right? If I only had $100 in here, then a $1,000 trade would be 10x leverage on my $100. If I have $500, then I'm using 2x leverage on my $500. And it just matters with the leverage you're taking, basically how much cash you have to pay for any potential losses in your trades. Deciding how much cash you want to tie up in order to fund your positions is known as leverage. And so it's leverage on top of the cash you're tying up. On the right-hand side of the trade screen, you can see this here, it says 10x. I'm going to click this, and then I'm going to toggle on this icon so I can change my leverage. Leverage means how big is your position size compared to the cash that you're tying up in the position. So 10x leverage means that if we want a $1,000 trade, then we put $100 in to fund that position. If we go down to 2x leverage, that means that same $1,000 trade with the market, we have to fund it by half, so $500. 500 times 2 is 2x leverage into a $1,000 trade. So each individual can choose how much leverage they want to take. However, the more leverage that you take, the more volatile that position is. Now that can be good and bad, of course, because each percentage move in the actual underlying assets that you're trading, when you're taking leverage, that is bigger, right? So 2x leverage means a 1% move in the underlying market. That's like a 2% move. 2% move up, 2% move down. So there's different ways to take leverage. Let's say I have $1,000. So what can I do with that? I can open a position of $1,000 in the market, and with 3x leverage, it means that I just put $333 down into that trade. I then have the other, dollars that I didn't tie up. I can take them off the platform. I can use them in a different trade or anything that I want. So you're not actually increasing the risk based on the cash that you have. You're just using margin in order to put less down into the trade. Maybe you want the other assets in your own hardware wallet or using them somewhere else to earn yield or something else. Or you can actually just use leverage to trade with more than you have, increasing risk. So that same $1,000 here, we can just take that $1,000 and tie it up with 3x leverage to trade $3,000 worth in the market. It's up to the individual what you want to do there. But each percentage move is made larger by the amount of leverage that you're taking. So with no leverage, a 10% move in a $1,000 trade is $100. 20% is $200, 300% is $300, and so on. But with 3x leverage, that just gets made larger. So a 10% move, if you're using 3x leverage, turns into a $300 move if you're making your trades bigger and using leverage to just trade with more than you have. So a 10% move is like a $300 move. Now that's like a 30% move in your underlying collateral that you have. And of course, if the thing moves 33.33%, then basically you're going to get completely wiped out of your $1,000 that you put in. So a 30% move, more or less, with 3x leverage, wipes out your collateral. Now, the other side of that is that if the price goes up 30%, then you've made way more as well. But it just matters that taking leverage increases risk and volatility. So you have to make sure that you're aware of exactly how the assets are going to move And if you can stomach volatility when that happens, because each percentage move is made larger. Now, what you can also do if your margin is becoming very close, so your position is losing money and you have an amount in there to pay for it, but that's getting pretty close where you might get liquidated, you can just add money into your margin account, which is essentially the same as reducing your leverage and paying off the position. And that means that you won't get liquidated because you have more assets to exactly pay for the position. And what you can also do in margin as well is simply just pay off the borrow that you're having and pay for the position overall. So we'll get into that. We have to choose between two different ways of margining our positions: isolated margin or cross margin. Now, isolated margin means that each of your positions individually has its own margin. So if you open up a Bitcoin USDT position, you have USDT there that you're borrowing, and that is firewalled in that position. Now, cross margin means that you're using all of your account and different assets in there to margin all of your positions. So let's say you have a Bitcoin position and an ETH position, and you have some USDT and you have some USDC and some other marginable assets. They can all be used to margin all of your positions. Now, isolated margin means that one of your positions, if it goes south and you lose money in it, it doesn't contaminate your other positions. But it also means that you have to be wary of each individual position so that if one is losing a little bit, you can make sure you put some more margin in if you don't want to get liquidated. But if you just say, you know what, I'm going to get liquidated, that one gets liquidated, your other positions are fine. With cross margin, one position can go south and lose money, and it may contaminate your other positions. However, your other positions, if they're making big profits, can also gain equity in your account to pay for the losses of that position over time. It depends on how you want to do it. If you're a beginner, you might want to start with isolated margin. And if you've got a lot of assets and you can use the value of those to margin your positions, you may want to go for cross margin. Isolated and cross margin actually have specific trading accounts, and this prevents contamination of the other assets that you hold on Binance. So what we can do is go down to the bottom here and then press transfer, and that lets us transfer in some assets. So I've got some assets in my fiat and spot account. I'm going to transfer it into my isolated margin account. And for isolated margin, you put assets into each specific trading pair. That's what isolated means, right? So that specific trading pair, you put assets in there, you can borrow against them, they're the margin, and it's isolated for that trading pair. So let's put an amount in, and you can transfer it over. Now, what we can also do is go to cross margin. So we're going to pick our cross margin account, which is this one. And you can see that the assets now are used across all of your margin positions. So let's say that we do have some BNB that we can use as margin. We can put that into the account. If you have USDT and other marginable assets, you can put all of those into your cross margin account, and it margins all of your positions and your borrows against them. So you can do that as you want and trade in either isolated or cross margin. It's also important to know what the potential interest rate is that you'll be paying if you do borrow assets in your account. Now, for any currency pair, this is going to be different depending on supply and demand. I've got Bitcoin USDT here, and for each currency pair, you can actually borrow either side of the pair. So let's say I want to borrow USDT. That means essentially I'm taking a short position in USDT. I'm borrowing USDT in order to buy Bitcoin. And so my interest is USDT. However, you can also borrow Bitcoin as well. You can borrow Bitcoin in order to sell the Bitcoin for USDT. So you're going short Bitcoin into USDT, hoping for the price to fall, and then you buy the Bitcoin back and pay off the interest and the loan. So you can borrow either of these assets. You can see the interest rates right here for each currency pair. So for right now, if I want to borrow USDT, I have to pay 7.6%. For Bitcoin, I'm paying 1%. That's an annualized figure, but it's exchanged hourly, so you can work that out. So that is going to be different for each pair and dependent on supply and demand. If you go down to this more here and click this, it takes you through to the interest history. So you can see the history of the two assets that you're trading and what it usually comes out at. You have to factor that into your trading, but that's the interest that you're going to be paying. Now, if you're paying over 8 hours or a couple of days, it's not going to be a lot. If you've got the position open a long time, then that interest is going to rack up, and that is a cost of your position. You'll also want to make sure that your account mode is in the correct setting for you. If you go to settings up in the top right and then go to account mode, most people will trade in classic trading. This is where you have cross margin, isolated margin, futures. Those are separate accounts with different collateral on their systems, and those trades are collateralized separately. You can also choose portfolio margin, where all of those accounts and the collateral in them and the equity that you have in your trading positions, either wins or losses, that's going to account for all of your trades. So again, this is like a cross margin, but across all of your accounts, which may increase the risk of loss in some trades. It may wreck you because one trade goes south and it wrecks your other positions. Of course, profits in those positions can pay for potential losses. It's up to you which you want to do. Classic trading may be easier to segregate some of your positions, so you may want to choose that one. Most beginners, I guess, will go for classic trading. Before showing you some sample trades, I'll show you how to borrow and repay money. So this is your asset screen right here, and we have a total balance. This is the amount of money that I have. So I transferred some USDT into my account. That's my account equity right here, which is the size of my position. I currently have no debt, and that means my margin level is essentially 0. Now what I can do is borrow money first. Now usually you do this when opening a position, but you can actually borrow the money first before trading as well. So let's press borrow, and it comes up with the borrow screen and says, how much do you want to borrow? So the max amount I can borrow is $80. Let's say that we want to borrow $50. And of course, we have $39 to pay for any potential losses and pay for any interest in there as well. So I'm going to borrow that, and I'm going to press confirm borrow. Now, what you should see down here, once this changes, is that my account equity and debt has changed, right? So the total balance now is $90. That is the debt that I have, because I have those dollars now. I've borrowed them, so I've got those as debt. But the account equity is pretty much the same as I just had. Minus some fees and initial payments that you get when borrowing the money. And so my total account balance is basically the equity and the amount of debt that I have. The equity will change depending on your positions and if you're making wins or losses in your positions and the amount of cash and other assets that you have there. The debt is obviously what we've taken out, and that brings us to our total account balance. Now we can go to our margin wallet, and I can see all of the debt that I have on account, any equity that I have there to pay off that debt, and my total balances. So if you go to your wallets, and then go down to margin, this one, it will take you through to this page. Now I can see the two different accounts, cross margin and isolated margin. In my cross margin account, I have an equity of $40, which is the cash that I put in there, USDT. This is my debt, which I borrowed, so $50, and my total balance is 90. So I have this much in order to pay for the interest of the debt that I took out. So, I'm not taking a lot of leverage at all, as you can see. It's absolutely fine. I've got loads of cash to pay for this because I borrowed dollars against dollars. So, I just have to pay for the interest. Down here, you can see that I've borrowed $50, and this is my interest that has racked up. So what I'm going to do is press borrow repay. I'm going to press repay. This is in my cross account, and let's repay $25 and press confirm repayment. That would pay off half of the debt. But what I'm going to do is press max like this. It pays off the interest and the debt itself, and then press confirm repayment, and that's done. Now, what you should see if you refresh the page is that your debt is completely gone here. So your debt's gone, and that leaves you with account equity of the amount that you had. If I press refresh here, that would come down to around $40 minus the interest that I just paid for opening and closing the loan position. Most people will probably borrow money when they're actually opening their trade. So let's go through an example. I'm trading Bitcoin USDT. I'm trading cross margin here, and I'll open a market order just to show you. I want to be borrowing, and you can see 3x leverage is what I'm going to take here. Now, as we move down, you can see I've still got that $39 in my account, and it says the max trade size that I can open is $118, which is roughly 3x my $39 that I've got in here. So when it says how much do you want to trade with, this total right here, what it's telling me is the value that I'm trading with the market. All right, so let's say I put $10 in here. I've got $40 in my account, and so it will not automatically borrow any money for that trade. It will just go ahead and trade with the market because I've got the cash there. If I want to trade on margin, then I have to put in an amount that is more than the amount of cash that I have, and then it will start borrowing for me. So if you've got cash in your account, it's not going to borrow money for you automatically. So let's go ahead and put $50 in, and you can see that the amount I borrow will come up. So I've got $40 available. This is the max I can trade with. And of course, if I've got $40 in my account with a $50 trade, I'm going to be borrowing around about $10. And so that's automatically going to borrow for me. Up here where it says borrow, that means automatically borrow if you need to. But if you don't need to, it's not going to automatically borrow. So it says margin by BTC here. So I'm going to press that, confirm all of the details and the debt, press confirm, and then you have an actual trade open. Now, what should happen also is that all of your assets should refresh, because now you have a USDT negative balance for your debt. So that's your liability. And you have more Bitcoin because you've bought that. If we go back into our margin wallet now, you can see how things have changed. So my account equity is now made up of the amount of cash that I have and the amount of Bitcoin that I have. Now, this is going to be mostly Bitcoin because I borrowed some money to buy it, right? I actually paid more than I have in cash. And so my account equity now is the value of my Bitcoin. That account equity can grow, which is great news. And if I make profits in the position, my equity grows in relation to my debt, which is great news because the Bitcoin is in my account and the value of that is being used to also collateralize my positions. So if the Bitcoin price grows, I've got lots of equity in my account. I can sell the Bitcoin at a higher price and I can pay off my debt. Now, if the Bitcoin falls, that collateral falls in value, and that's where you start getting, more and more leverage based on the actual value of your account. And so if the Bitcoin falls, then at some point, it's going to fall to a level where I can't pay off my debts, and then I'll get liquidated by Binance, and they'll pay off my debt. So I've got this asset here, Bitcoin, and that's mine. I can switch it over into my spot account. I can withdraw it from the platform. I own that. I also own this liability to Binance, which is the debt right here. You can see the borrowing is 1096. So how do I pay this off? Well, I can actually transfer assets from my spot account into my margin balance. So let's go transfer here. We're going to transfer from fiat and spot, and we're going to transfer it into cross margin. So I'm going to press $5, and I'm going to press confirm. That transfers in those assets into my balance. Now you can see that my total balance is $5, and I've got $10 borrowed. Let's go and repay the borrow that we have. So I'm going to repay. I'm going to go to USDT, press max, and then press confirm repayment. What happens here? You can see that my borrowed amount's gone down. I've basically paid off the loan. My Bitcoin, I've already bought that. That is in my account and I own it. That's my property now. It's just that USDT is the thing that I've got a liability on to Binance, and I've just paid half of it off. So you can do that. You can buy the Bitcoin and then pay off the USDT over time if you want. And that's going to reduce any margin that you have because basically I had $10 of debt there and I've just paid half of it off. The other way to pay off your debts is to liquidate some of the positions that you have in your account in order to pay for them. So I've got a position of Bitcoin now and that has a value. But I also have a debt of this USDT. So what I can do is take some of that Bitcoin and sell it for the amount of USDT that I need to pay off. So you can do that in your trading screen. If you go down to positions here, what I'm going to do is I have this USDT debt and I'm going to pay that off by pressing close position. And it says, you have this debt. How do you want to pay it off? And down here it says, this is the asset that you have. We can sell a portion of this to pay off your debt. So I can press confirm and that sells off that position and it closes out my debt. So now I don't have any more debts and I've taken the profit and loss of when I open the position. Right, so if you've taken a position long Bitcoin and you borrow dollars to do that, when you close it out, all that's going to happen is the equity in your account is going to go down by the amount that you've paid in interest and the profit or the loss that you've made. If you've made a loss, your equity will go down. If you made a profit, your equity will go up and you would have made more of the asset. So now I've actually got Bitcoin in my account, right? Because I bought the Bitcoin and I had the debt in USDT. And now I've totally gotten out of my debt by selling the Bitcoin, some of the Bitcoin that I bought in order to pay any costs. So now I've still got that position of BTC in my account. What we just looked at is essentially borrowing dollars in order to go long the asset. But we can also do this on the sell side where we actually sell the asset. So we can borrow Bitcoin in order to sell it. And we can borrow more than we have in the account. So I'll show you the two ways of doing this. The first one is using dollars to collateralize your position. So right here, I've got out all of my positions and you can see that I have a total balance of this in my account, these $44 USDT. What I'm going to do is sell Bitcoin and I'm going to sell more than I have. So let's go and put an amount in that we want to sell. And we should say borrow here. And I'm going to put this amount in. And you can see that as I slide this up, what I'm actually doing is selling Bitcoin and borrowing Bitcoin to sell it because I don't have any Bitcoin in my account. Now you would do this funding with dollars to borrow the asset and sell it. You're essentially speculating on the price going down and you have an amount of dollars there to fund any potential losses in the trade. Now the potential losses can be significant if you're short the asset because you're selling it first, hoping to buy back later lower. And that's how you make your money. Now, if you sell and the price goes up, you can make losses pretty quickly for sure. So you have to be aware of that. But we're going to borrow Bitcoin and sell it, even though we don't have any Bitcoin in our account. So what we'll do here is borrow amount. You can see this. We're going to borrow this amount of Bitcoin. And we'll just choose a little bit less here. And we're going to press margin sell. Going to check those details and press confirm. Now, what you should have is a long USDT position now. and a Bitcoin debt that we need to pay back. Now, if we go back into our margin wallet, you can see the balances here. We have a position in Bitcoin, and you can see the borrowed amount. So we've actually borrowed Bitcoin to take a short position. We've borrowed it and we've sold it in the market. And in order to get out of that position, we would need to buy it back. If we buy it back lower, we make some money. But because we've traded, we also have a balance of USDT in our account. So again, what we're going to do here is pay back the Bitcoin. Now, you could go to borrow, repay. And if you have Bitcoin in your spot trading account, you can just transfer it into your margin account to pay off the debt. Because you've sold Bitcoin and you're short Bitcoin to Binance, you can just pay off the debt by putting some Bitcoin in your account. Or again, you can trade out of it very easily. So we're going to trade out of it this time. And what we'll do is pay back this Bitcoin balance and obviously spend out the USDT. So what we'd be doing now is actually buying back the Bitcoin. So go to your positions. You can see that we have a Bitcoin debt right here that we need to pay back. So we're going to go close position. And it says you've got USDT in your account now because we sold the Bitcoin for USDT. So we've got that USDT in our account. We're going to put that into the trading screen. We're going to use that to buy Bitcoin and pay off the debt and then exchange the balance of fees and any profit and loss. So we're going to press confirm and that will get our Bitcoin position out. And we should have the balances back in our account where we basically have the USDT and any profit or loss that was made in the trade. Another way to use the sell side of the order book is actually to use the assets that you have as collateral to margin your sell positions against them. This is known as hedging. So if you've got Bitcoin on the exchange and you think the price is going to fall, well, you could just let the price fall, or you could hedge your position with a sell side trade on margin. That means that you don't sell your asset. You use the value of the asset to collateralize a short trade. So you have your Bitcoin in your margin account and you take a sell side trade, which benefits from the price going down. So even though your collateral is falling in value, you are hedging that via a short trade or a sell trade in the margin position, which makes money as the price falls. That's known as a hedge because even though your collateral is losing value, your trade is actually making up some of that value as the price falls. Now, the downside of this is if you get the trade wrong, then the price rises. Your collateral rises, but your trade cancels that out. So that's the downside if you get the trade direction wrong. But how to do this? I've actually changed my assets in my account here. So you can see I've now switched everything into Bitcoin except for $1 here. And because Binance uses the USDT value of my collateral, I can trade this Bitcoin. And so in the trading screen, you can see down here, it still tells me that I've got around the same amount of collateral to play with. And that's because it just makes the dollar value of it for me to trade with. So I can actually sell. I can sell the Bitcoin I'm going to borrow. And right here, it tells me how much I'm going to borrow, as you can see. And so the estimated fee and everything, and I can actually short the asset using the asset as collateral. So let's go ahead and margin sell BTC, press confirm. And now we're taking a short position in the asset, but we're using the asset to go ahead and margin our position. So what should happen here is that as the collateral falls in value, the trade will make money, and that means the equity in my account rises. And so it should cancel out a little bit of my losses. Back in our margin wallet, you can now see that Bitcoin that I had has been turned into a small borrow, and now I've got a balance of USDT in my account. So that's the same as selling the Bitcoin, and now you have the USDT balance. If the price of Bitcoin falls, you can buy it back at a later date at a lower price, which means your trade had hedged some of the downside that the BTC would have had if it was just sitting in your spot account, losing in value. If you need way more specific guides on using margin, day trading, or trading in futures, I'll leave those videos down in the description, plus some deposit and trading bonuses on the exchanges I use down there as well. I'm James, it's MoneyDG. Cheers for watching, and I'll see you in the next one.